All right. Well, good afternoon, everybody. Thank you for joining me today. I apologize that I am a minute late here and getting this moving forward, but I look forward to having an information-packed hour. So for those of you who are joining me on Zoom, I'm going to have everybody muted, but if you have questions, I really do want you to post in the chat any questions you have as I go along. I will either address those questions at the moment that you post them, or I will address those later on when they become more relevant in the presentation. But let's go ahead and get this kicked off. So again, appreciate everybody being here. My goal today is to talk about a few things. The first thing I want to talk about is interest rates, kind of where they're at, where they're going, and what we expect to happen as we move forward in a recession, because we're definitely in a recession. And we need to be aware of what that's going to mean, because there's a lot of things that people misunderstand about what it's going to mean to interest rates. I'm also going to talk about the housing market and kind of what we expect to happen with the housing market and house prices going forward. We'll spend a little time talking about buying and refinancing. Is this a good time to do that or not? And then we're going to talk about forbearance challenges. Talk about what it means to be in forbearance, what some of the consequences and challenges are, and what some of the benefits are. And so we can have a real frank conversation about forbearance and if it's the right thing for you. So we've got a lot to cover. So let's go ahead and dive right in. So the first thing I want to talk about is interest rates. And I want to share with you a little bit of how things work behind the scenes. So what you guys are seeing right here is essentially the rates that the investor likes or doesn't like, how much the investor likes or doesn't like mortgages. In other words, when this number goes up, that means that Wall Street is happy with mortgages and they want more of them. And so therefore we pay a lower interest rate. And so up on this chart is a good thing, and it means rates have been going down. And so what you notice is starting back in December, we had decent rates, and then they kept getting better and better and better. And again, there's ups and downs and peaks and valleys. But right here on March 9th, we had our best rates ever. We were down between 2.75 and 2.99, depending on the type of loan. And that's for a fixed rate mortgage. And I've been doing this for 19 years. That is by far the absolute best interest rates I'd ever seen. They capped out on March 9th at the best rate we had absolutely ever seen. And then the market became really volatile, like huge swings up and down. And if you notice, like over the prior 3 months, these movements are really, really small until we get around here. And this is when all the shutdown issues happened. The coronavirus, COVID-19 caused major challenges, as we all are aware of, with the economy, and it didn't spare the mortgage market. Huge, huge volatility that's created some major challenges that I'll talk about going forward. And so what's happening is that volatility caused rates to drop significantly because the Fed stepped in. And the Federal Reserve said, we're going to fix the problem. We're going to buy mortgages and we're going to become the #1 buyer in mortgages. But they kind of bought too much too quick. And it caused huge swings. And we saw interest rates go up and down. And at this point right here, we had the highest movement in a week that I had ever seen. And we had rates go from 2.99 to 5.5%. I had never, ever in my career seen interest rates move that quickly. And so we had huge volatility. And then we see interest rates get better than where they were on March 9th. So I've said over here, our best rates ever were on March 9th. And you're looking at it saying, well, John, you're crazy. Because you're showing me right here that since March 25th, we've had better interest rates than we ever had on March 9th. Well, no. What happened is we had a new problem. The problem is a big disconnect between our lending rates and our cost of funds. And so what's happening that you're seeing here is, what is the Fed, who's the biggest buyer of mortgages, willing to accept as an interest rate? And the Fed's saying, man, I love mortgages. I'm going to buy them till the cows come home. And so you've got the Fed saying we're going to keep rates super, super low. But the problem is the banks on the front end have multiple challenges they're dealing with. The simplest of those challenges is too many people trying to refinance at the same time. And when too many people are trying to refinance at the same time, it takes longer to do a refinance. And we have a cost in our industry for the risk if rates change between now and when we fund your loan. And that risk was exacerbated right back here when these rates started jumping up and down. There were fees to the millions of dollars in the mortgage industry because of that volatility. And so the mortgage industry said, wow, we're super scared about long-term rate locks, but We're also unable to complete loans very quickly because too many people are trying to refinance. So here's the solution. We'll just charge everybody a higher interest rate, and that'll slow down the number of people wanting to refinance, and it will give us extra profit to extra income to cover the losses we have over the long-term lock. On top of that, they're worried about rates continuing to go down. And that worry about rates continuing to get better means that the investor, the bank, isn't going to earn their interest for very long, because who knows if a year from now rates could be at 2.5% or below. And so the market is now worried that, well, man, I don't want to give too low of an interest rate, because then that person, I'm not going to make enough money on that. I got to build in some extra profit. It's creating some major upheaval in our market, and we're not seeing as good of rates as we should be seeing right now. Now, we have good rates. Rates are between 3.1 and 3.5% on average. Super good, but nowhere near as good as what they were on March 9th. And that's the challenge we're dealing with today. Rates should be much lower than where they are today. And so here's what I tell my clients. If you're buying a home, you have no choice on timing, because your goal is to find that home. And when the perfect home comes up, you only have 30 days to close escrow on it. You don't have a lot of time to deal with all of this volatility, where who knows what's going to happen next week, what's going to happen right after that. And so you can't afford to wait in locking your interest rate. But when you're refinancing a home, now you have time on your side. And so we're being very forward thinking in our advice, because most banks, when you call them right now, are simply going to say, hey, here's today's rate, lock it in. Well, that's kind of silly if what we're seeing here is rates should be way lower than where they are right now, because they aren't even as good as where they were here. They're more like right around where they were at the end of February. That's where rates are today. We got a lot of room for rates to get significantly lower. And so we're telling our clients, do not lock your loan. It's a bad idea. You want to get the best interest rate. We want to get you the best interest rate. And so by starting your loan and only locking it once the loan is approved, I don't have that risk of locking the loan for 60 or 90 days and worrying about what's going to happen in the meantime with volatility. And therefore, we can pass along a lower interest rate to you because we don't have to pay for that risk. It also lets us pick the best day to lock, because that's the other challenge. If you called me today and I was like any other lender who says, sure, let's lock today, well, that's just luck on whether today was a good day to lock or not. But once we have your loan approved, now we have the option to choose when we lock the interest rate, because a loan approval is good for 4 months from start to funding date. And so we have time to lock the interest rate. And at this point in time, we expect rates to stay the same or get better, because the Fed essentially has an unlimited bank account. They're writing checks every single day to buy mortgages, and they're buying them at such a level that they're keeping the interest rates super low. And we expect that to continue at least through the end of this year. And so we really do see rates staying low and potentially going lower. The challenge is whether that extra risk cost that the mortgage industry is dealing with goes away or not. If it doesn't go away, then rates will stay around where they are right now. But if it does go away, rates should be a lot better. And so we don't want people locking interest rates on refinances. We want to get them fully approved and pull the trigger when the time makes sense, and we're locking you for a shorter period of time. All right, so remember, guys, if you have any questions about anything, please post it into chat so that we can answer those questions for you if you're in the Zoom. If you are on Facebook, I'm trying to watch Facebook, but I'm much less likely to catch a Facebook chat or Facebook comment. But if you have any questions about this, post them into the Zoom chat and I'll make sure to answer them. Let's move on to talking about housing. So the question I get from a lot of people is this a good time to buy a home? Well, the reality is that it really is a question of what are your goals. For most people, today is an amazing time to buy a home, because we expect housing prices in the short term, they're definitely going to be rocky. We've got major issues with sellers not wanting to sell, buyers not wanting to buy, because nobody wants to go out, and in most cases, nobody can go out during the shelter in place that we're dealing with. And the truth is, you don't want to go into somebody's home when you're worried about this illness that's going around. And so there's not a lot of transactions happening right now. For those that are courageous and willing to buy a home without necessarily going through it and doing all of the in-person walkthroughs, Your inspector can still go through it. You can actually get a pretty good deal right now because the people who are trying to sell right now are more likely to have a real need to sell their home. And so you have an opportunity to buy that house without a lot of competition. But guys, here's the other side of the coin. Housing prices during recessions go up. 3 of the last 5 recessions, housing prices increased, not decreased. But the problem is the most recent recession was the Great Recession back in 2008. And that's everybody's memory of recessions is, oh my gosh, if there's a recession, housing prices crash. No, that's not true. The Great Recession in 2008 was caused by housing. It was caused by problems in the mortgage industry and caused by problems in the housing industry. And so that brought the house of cards down on top of them, and that absolutely decimated home values. But if you take that one recession out of there, then 3 of the last 4 recessions, 75% of the time, housing prices go up during a recession. And here's the simple reason why. Because rates stay low. Rates stay low in a recession because the federal government is doing the same thing they're doing right now. They're pumping money into the markets to lower interest rates to spur people spending money, because that's how you get out of a recession. And so whether you agree with it philosophically or not, it's a fact. And so people who are concerned about housing prices dropping as we're hitting a recession, I can't guarantee the future, but I can tell you that everything points towards a strong housing market, including the demographics. And so if you think about it, there was a large segment of the population over the last 10 years that were called recent college graduates that they called the boomerang kids. Everybody remembers the term the boomerang kids. They'd leave the house and go to college, they'd graduate college, and boomerang, they're right back home. And so the problem is that those people, the problem back then was demographically, they should have been buying homes and they weren't. And so 10 years ago, 8 years ago, 5 years ago, we had a segment of the buying population in their 20s that wasn't buying. Guess what? They're now in their 30s. They're now getting married. I might be talking to some of you on this video right now. You're now getting married and you're going to have a baby, and you don't want to be in mom and dad's basement with the baby. I mean, yeah, you got built-in babysitting upstairs, but aside from that, I don't know about you, but I don't want to be in mom and dad's basement with their grandchild. So you want to buy a house. That's a huge driver in the market that we're seeing. We've been seeing that over the last year, and that demographic is getting more and more prevalent of those people who weren't wanting to buy their own place now wanting to buy. That's another reason why we expect the housing market to stay strong. From a forward-looking perspective, the people that I follow are talking about 2025 to 2027 before we see this increase in housing prices start to crest. Now, what happens after the crest, I don't know. But historically, just like you saw the ups and downs of interest rates, the long term of housing is a good thing. And that's why it brings me to my time machine question. So I want to ask you guys, anybody who's on the Zoom chat, I want you to post in chat right now. If you could go back to 2008 and you could buy a home. Now, mind you, 2008 was the top of the market and prices fell significantly after that. Tell me, yes, I would buy, or no, I'd be a renter. So play along with me and type into the chat, would you buy a house or would you be a renter? If you could go back in 2008 and choose whether you would buy at the top of the market or would you be a renter, which one would you do? Come on, guys, play along with me. Type in. Let me know you're really there. My Facebook friends, I see 7 of you on there. Tell me whether you'd buy or you'd be a renter. I got a buy, I got a renter, I got 2 renters. I got 2 buyers and 2 renters. Do I have a 3rd buyer? I got a 3rd buyer. Do I have a 3rd renter? Come on, 10 will get you 20, 20 will get you 30. Come on. No, okay, I'm not an auctioneer. All right, so I got another renter. Good, so we got a good cross section here. Here's my answer. My answer is absolutely I'd be a buyer. And here's why. Because if you're not a buyer, you're a renter. And what happened with rent payments, what the cost of rent was from 2008 until today? It skyrocketed. Absolutely skyrocketed. So over that 12-year time frame, you've been paying your landlord's mortgage for that whole last 12 years. Instead, you could have been paying your own mortgage. Mind you, it's about having a fixed interest rate with a fixed payment that you can afford. Now, in 2005, we weren't doing that. We were giving you adjustable rate mortgages. My industry was horrible. Yes, buy in another state now, please. Get out of the state. I got you. So the reality is that that's the first point. If you were a renter, your rent payments were skyrocketing. The second point, every payment you make towards a mortgage has a portion of the payment going towards principal. You, 12 years later, would have paid down a significant amount of your principal balance. In other words, you're building equity not just because housing prices are going up, you're building, because they didn't, but you're building equity because you're paying down the principal, and housing prices did rebound. Housing prices are at or above what they were back in 2008. So you had 12 years of principal payments paying down the mortgage for that 12-year time frame. Prices dropped and they came back up. So if you were to sell that house now, you'd have a good amount of equity. And the third reason why I would do it if I had that time machine is simply because of the tax breaks. Because if you are a renter, you are paying a significant amount of money in taxes that you don't get the tax benefit of mortgage interest and property taxes that you would get if you had owned that home since 2008. Not to mention the fact that you don't have to worry about your landlord getting foreclosed upon and evicting you. I'm sure that happened to a lot of people, including probably some of you on this call. And so that's a really important thing to think about when people try and time the market and say, I don't want to buy because it's not the top of the, or it's at the top of the market and I don't want to do that. I think that's a really bad idea. Oh, my Facebook friends, I had a couple people say buy as well. Awesome, I like my Facebook participants. Okay. So what we've got is the opportunity now to think about long-term. I'm not telling you we're in the 2008 era where prices are about to drop. I just told you I think they're going to keep going up. But the fact is, I think it's a great time to buy as long as you're not trying to speculate. So that's the biggest challenge. Buying investment or long-term plans. If you're buying a property to flip, I'd be worried right now, because we got a lot of volatility going on. I'm not saying don't do it, but you need to, this is not the time to dabble in flipping homes, in my opinion. This is the time to buy a great primary home. If you wanted to upgrade to a luxury home because, hey, I've got some good income and it's a good time to make that upgrade, it'd be a phenomenal time to do that. But if you're speculating, that's where I'm a little bit concerned. Not saying it's a bad idea, but definitely that short term, you just don't know what's going to happen in 3, 5, 7, or 10 years. But long-term, home ownership gives you huge benefits no matter when you buy the home. All right, any questions about anything related to home buying before I move on to the next step? All right, if you have any questions, posted in chat. Let's go ahead and talk about questions to ask when refinancing. This one's really big for me, because a lot of people talk about, you know, hey, John, I got a phone call from a bank and they said I should refinance and I'm saving a certain amount of money. And so, you know, I'm gonna go ahead and do it. And I'm like, look, you gotta look at the cost benefit. You've got to look at how, you know, a lot of things have to come into play. Most importantly is be careful of the fees and the time that it takes you to recoup. Most people don't have their mortgage beyond 5 years. Something changes. You need to pull cash out, and so you refinance. Interest rates drop, so you refinance. You have another kid, so you got to sell and buy a bigger home. Your kids graduate college, and you got to move and buy a smaller home. Your kids go to college, and you got to move to pay for college. Any number of things are going to happen. And the reality is that you need to be worried about time, and you have to look at it, can I recoup my money in the first 5 years? The second thing I'll tell you, rate is not a reason to refinance. Let me say that again. Rate is not a reason to refinance. Too many people call me and say, hey, John, I heard rates are low and I want to refinance to get a lower rate. There is zero benefit to getting a lower rate, because sometimes you're paying so much in fee to get that lower rate that it negated any benefit at all. So you have to look at, what are you going to do with that lower interest rate, and does the math make sense? So let me give you a couple examples. Maybe you want to shorten your term. So if you got a lower interest rate, you could actually keep your payment the same and pay off faster and save a lot of money in interest. Maybe you decide, hey, you know what, John, I need some cash out. Well, if you pulled cash out and your interest rate dropped, then your payment could stay the same because you were able to take advantage of a lower interest rate. Or maybe you're saying, yeah, you know what, it's kind of tight right now, or I'm worried about it being kind of tight down the road, and so I want to lower my monthly payment. So in that case, maybe we extend out your term of the loan and we lower your interest rate and give you a lower monthly payment. Sometimes it's 2 or 3 of these things. So it could be any variation of them, but it has nothing to do with getting a lower interest rate. Do not let anybody talk you into the lowest interest rate. Not to say low rate's bad, but interest rate is a tool. And the other thing I'll tell you is if you can get rid of the mortgage insurance, that's great, but you have to think about the cost of getting rid of the mortgage insurance and what that does to your interest rate. Too many people are hyper focused on one thing. And I'll give you a great example. I had a client who was hyper focused on not paying mortgage insurance. And the problem is his credit wasn't so great, and so he had to go FHA. And he said, John, I'm refusing to do it because you said I have to pay mortgage insurance with FHA. And I said, yeah, but your overall cost of your loan per month is cheaper. And he goes, no, but I have to pay mortgage insurance, and that's a waste of money. And I said, okay, let me ask you a question. If you were trying to buy a truck, and you knew that you could buy that truck here in California for $20,000 and you'd have to pay $4,000 in interest. So not interest, in taxes, in sales taxes. So you're buying the truck for $24,000, including tax. And you say, I refuse to pay tax. I'm not paying tax. I'm not going to do it. I'm going to go to Oregon and buy the tax. But the problem is the price of the truck in Oregon is $25,000. And you have to pay the fees to get the truck shipped down from Oregon. That'll cost you an extra grand. So you paid $26,000 to get a truck in Oregon, but you didn't pay taxes. Woohoo! I won. I didn't pay taxes. No, you lost because you spent $2,000 more than you needed to. That's the same concept for the person saying, I refuse to pay mortgage insurance, or I'm going to refinance to get rid of my mortgage insurance. Well, yeah, you're getting rid of the mortgage insurance, but it's actually costing you more in the long run because your rate went up and you paid a whole bunch of fees to do that. And so don't put the blinders on and get hyper focused on any one thing. You need to have a consultation that helps you understand all of your options and how to best customize the scenario to meet your needs. And so this is a big thing for me. So I'll remind you guys, if you have any questions about anything, please post them in comments. But I'll tell you that when you're thinking about refinancing a home, you really do have to look at the total cost and analyze the total cost of doing the loan. What's it going to cost you in interest over the life of the loan? I'll help you decide. I'll help guide you. There are a lot of people I tell it's not a good idea to refinance. Some of you on this call right now I've told before it's a bad idea to refinance. Other ones I've stood on my desk and screamed at you, you need to refinance, because I know how the numbers work and I know what makes sense. And so you need to take a grain of salt when somebody shows you a really low interest rate, because sometimes it isn't what is expected and there's a lot more cost behind the scenes. All right, any questions about refinancing a home? Any questions about the housing market in the future and buying homes? Feel free again to post those in chat. I'll be happy to answer them. And if there's nothing else, then I'll go ahead and move on. So I want to talk about the forbearance tsunami. And the first thing I'm going to talk about is what I mean by a forbearance tsunami. So there's a lot of people filing for forbearance right now, and there's some challenges that that's creating for the mortgage industry. Now, I'm not going to cover any of that with you because as a homeowner, that's not your problem. The problems with the mortgage industry are the problems that the mortgage industry has to bear. Very simply, we've got a bunch of people who are going into forbearance. I see your question, Denise, and I'll go back to that in just a second. There's a lot of people who are going into forbearance and they don't understand the consequences of what a forbearance means. And so that's the key that I want to cover with you is what does it really mean to go into forbearance? Before I cover forbearance, I'm actually going to talk about Denise's question. So she asked, how do you calculate the cost for refinancing? So it's pretty simple. You really have to take what your upfront costs are and compare that to your current and what you're going to pay in interest on the new loan, compared with what you would take if you just kept your current loan and maybe paid a little bit extra in a monthly payment. So I've got a tool that I use called my total cost analysis that does exactly that. So that tool helps a lot. And if anybody has questions that they want to know, hey, John, I got numbers from somebody, I'm not really sure if it makes sense, I'd be happy to run my total cost analysis and show you if it makes sense. There's a lot of times that I tell clients, it's not worth the trouble of refinancing, because if you just add an extra, I got a lot of people wanting to switch to 15-year mortgages. And the problem is you got a bunch of fees that you add to the loan, and the shorter your mortgage term, the less you are paying in interest dollars every single month. So if you get a 15-year loan, most of your payment goes towards principal. So saving 1% off of your interest rate doesn't help you as much as it does on a 30-year mortgage. The same holds true on small loan amounts, because the cost of doing a mortgage, it costs the same for us to do your mortgage, whether you're borrowing $100,000 or $500,000. And so if you have a $150,000 mortgage, you need to save a lot of money in interest in order to offset what the upfront fees are. If you have a $500,000 mortgage, you don't have to save as much in interest rate because your dollars of your loan are a lot higher. And so I appreciate you saying thanks. I was about to ask you, Denise, if that answered your question. So guys, it isn't a simple question and answer of how do you determine what the cost benefit is, but it's a bigger picture, deeper dive. If you're on the phone with somebody and they're simply saying, hey, I can give you, 2.99%, your payment is this, and there's no cash to close and you get to skip 2 payments, run. Like, run as fast as you can, because that's not the reason to do a loan. You need to understand what all the costs are and be able to compare side by side. Get a tool like I talked about, my total cost analysis, that allows you to compare options side by side to see what makes sense. Carlos just got in here. Carlos said, thinking about doing it, but what's the most efficient way of figuring out if my home has appraised by 20% without getting an appraisal, if there is a way? All right, so that's a tough one. Very simply, you can go to Zillow. That's a starting place. I don't love Zillow. Zillow uses computerized guessing, and when you look at Zillow and you dive in deeper, it says, hey, your house's estimate is $375,000. But then you dive a little deeper and it says, but we think it could be anywhere from 4.25 to 3.25. Well, that's a pretty big range of interest of values, and that's not an appropriate way to get an estimate of your home value. The second thing I'll tell you that's a major concern, Zillow is not accurate. Call a realtor for help. You're right, Barbara. I'm so sorry I didn't start there. How horrible of me. Call a realtor for help, Carlos. I'm done talking about it. No, I'm kidding. I am not kidding about call a realtor for help. Barbara's 100% correct. But Barbara, hear me out. You can go to Zillow to dig deeper and see individual homes that have sold. And in seeing yeah, I know, Kathy. Okay, all the realtors pile on me. I'm sorry, shame on me. I'll beat myself up. Okay, so, but you can go to Zillow or anywhere, and you can look to see what similar homes of a similar size as yours has sold for, to get a feel for your home value. Here's the couple of challenges. And I'm gonna challenge realtors right now. So feel free to pile on me again, ladies. So a couple of challenges. First and foremost is, when a realtor's looking at a value, they're looking at what they can get for your home. And so if you've got a range of homes that have sold for, 350, 360, and 365, and they're looking at the difference between all three, they're like, look, they're all three pretty simple. I'm a great salesperson. This is a rising market. So I'm gonna get you as a matter of fact, I'm gonna get you 370. Because prices are moving up and I can get you 370, that's what your house is worth. That's an accurate statement from a realtor's perspective. From a lender's perspective, a lender is looking at it and saying, okay, you got a house at 350, 360, and 365, and they're all about the same. We really can't tell the difference, just like the realtor said. But we're gonna say, well, then if we can't tell the difference between the three, we're gonna assume the 350 number. We're going to go on the lower end of the value instead of the higher end of the value, because there's never an exact comparable sale. The perfect definition of a comparable sale is your exact home sold yesterday across the street. Okay, so it's similarity, it is recency, and it's proximity. And so if it is a similar home to yours, in other words, the exact model of yours, it sold yesterday, then it's recent, and it's right across the street, then it's in the same proximity, then that house's sales price is your house's value in the eyes of the bank, okay? So the other challenge I will tell you is, too many people, including some realtors, give too much weight to cost per square foot. I hate cost per square foot. I don't ever use cost per square foot, because cost per square foot takes you down the wrong road. Because if you think about it, what you're buying is, you're buying the neighborhood. You're buying the amenities, you're buying the parks, you're buying the school district. And so if you buy a 1,000 square foot home in the neighborhood you want to live in, Are you going to pay half as much as somebody who buys a 2,000 square foot home? Let me say that in a different way. Would you pay double the price for a 2,000 square foot home in the same neighborhood as a 1,000 square foot home? You wouldn't. So price per square foot is skewed. I had a client last week that was saying, hey, we think the price per square foot on this house is really high. My realtor says that it's appropriate, but I think it's super high. And I said, what's the square footage of the home? And they said, it's 950 square feet. And I said, is that the average size of the home in that neighborhood? No, it's the smallest in the neighborhood. And I said, you have to understand, you're buying the neighborhood and you're happening to put a smaller house in that neighborhood. And so you're going to be less expensive in dollars than the other homes in that neighborhood, but you are going to be more expensive in price per square foot, because that same home, if you moved it to a different neighborhood, would be a lot less expensive because you're buying the neighborhood. And so, Carlos, I hope that was a long answer to a simple question. You have to look at individual home sales. Most importantly, you have to talk to a realtor. If you don't know a great realtor, I'll help you find one. You need to talk to the realtor that helped you buy your home because they took great care of you when you bought your home. All right, where's my pat on the back? True dat. Thank you, Kathy. I was looking for a pat on the back when I said that. All right, so guys, here, that's it for that answer, Carlos. Hopefully that answered your question. If you guys have other questions about this, feel free to post them on Facebook or on the group chat. What I'm noticing is Facebook is delayed a bit from what I'm saying, and so I don't see your comments right away on Facebook. Okay, so the bottom line is forbearance. So guys, here's what happened. Last month, the president passed the CARES Act. And the CARES Act provided a lot of benefits for people. Again, I don't want to make this political. I don't care whether you think it's a good or a bad idea. It's just a fact. It's what we have. And the CARES Act provided the opportunity to assist people in lots of different ways. And one of the ways that they provided was the opportunity to get a forbearance. And the purpose was to say, hey, you're going to have people who can't afford to make the payment because literally we shut down the economy and they're not working. And in the past, when banks had a hardship, they were required to prove that you had a hardship in order to give you a forbearance or a modification. And if anybody was a homeowner back in 2008, some of you probably have been through challenges where you were a homeowner and you wanted to modify your mortgage and you had to send a whole bunch of paperwork to the bank. And then 3 months later, they'd call you back and say, yeah, we lost some of it. They never said that, but they did lose it. And then you had to send them all the paperwork again. And then they called back again and said, oh, the paperwork's expired and we need you to get us more paperwork. And it's a vicious cycle. And the government knew we could not afford that vicious cycle. So they said, look, anybody who claims that states that they are impacted financially by the COVID-19 shutdown, you can have an automatic 3-month pause button on your mortgage payment. You could theoretically extend that to 6 months easily. And the bank has the option to extend it to as much as 12 months of no payments through the term forbearance. It also said very clearly that it will not negatively impact your credit score. And that's a very true statement. It is not going to negatively impact your credit score. But there's a lot of pieces to this that weren't as clearly defined that I want to try and define for you guys today. So first of all, forbearance will impact your ability to borrow money in the future, because they're not showing you as late, but they're showing you as being in forbearance. And duh, John, we're in forbearance. But the problem is, in forbearance means that you didn't have enough money in savings to make it through 1 or 2 or 3 months of a rainy day. And the truth is, from a lender's perspective, that's a risk. Now, I know it's pretty common. It's not, I hate to say it's the American way, but it is, that people are not saving a lot of money. But you're showing your cards by saying, I haven't saved enough money and I needed a bailout. I need help from the government. I need help from the banking system. And there are negative implications to that. Just like the banking industry got a bailout in 2008, and again, you can claim that that was their own fault or not, but the fact is that the banking industry had to get a bailout and there were negative impacts long-term. It will affect, because your credit report is going to say you were in forbearance. I know for a fact right now, because I have a client whose credit report says that they were in forbearance, that I cannot do a mortgage for that person for the foreseeable future. We've not defined yet what that future is. But here's what I think. I think that it's going to be at least 1 year from after you started catching up your monthly payments. So you talk about how you catch up the payments and what that looks like. But if you're simply in forbearance, it means, hey, I couldn't make my payment during this time frame. But we always have to prove when doing a mortgage that you have 12 months of on-time payment history on a mortgage. And so if we look back in 6 months from now, we look back and we say, well, you had 6 months on time, but you had 3 months off. Well, then that's not 12 months of consecutive on-time payment. You weren't late, but you didn't make payments all 12 of those months. Therefore, we'd probably have to wait a year from the time that you caught up the forbearance before you'd qualify for another mortgage. And I told you guys earlier, we expect interest rates to stay low, potentially going even lower than where they are right now. And so you're losing that opportunity to take advantage of those lower rates if in fact that happens by going into forbearance. Now, don't misunderstand. If forbearance is the only way that you can afford to put food on your table, go into forbearance. I'm not trying to scare you out of doing it. I'm just trying to give you as much knowledge as I can about how this works. So Kathy asks, so basically it just prevents foreclosure. It doesn't really even do that, Kathy. And I'll explain more in just a second, so I'll get back to that. Wendy said, when they come out of forbearance, do they have to pay back the previous months at that time, or do they have to go to, or do they go to the back of the loan? Well, Wendy, that's a phenomenal question. Thank you for asking. Wendy works for me, but this was not a planted question. But anyway, I'll go into that in just a second. So it's right here. Talk to your servicer about how they want you to make up the payments. The truth is the servicers have no idea yet. The federal government threw these rules out and they never talked to the banks. The banks now have to figure out, well, first of all, how do we staff up enough to even answer the phone when somebody is calling to ask us these questions? They can't staff up fast enough. And so what they've done is they've put recorded messages on their voicemail that says, hey, if you're calling about forbearance, here's what forbearance means. Forbearance means that you get to skip 3 payments, and at the end of the 3 payments, you may have to pay all of those 3 payments plus your next payment back at the exact same time. If you'd like to proceed with forbearance, please press 2. And that's it, okay? Or they put a little note on your website. And you go in there to make your mortgage payment, and it says at the top, would you like to have a forbearance on your loan? You click the button that says you'd like to, and boom, boom, you're in forbearance. Because the banks are prohibited from asking for any proof that you needed to be in forbearance. The general thinking, and this kind of goes to what Kathy asked about, does it just prevent foreclosure? Well, yeah, if somebody loses their job, which we know a large portion of the American population is out of work right now, and they can't make their mortgage payment, then once they're 4 months behind, then it goes into the foreclosure process. And so this prevents that from happening, but it also prevents their credit score from being harmed, and it gives them some options to, hey, maybe in 4 months, I'm able to get back to work and I can get back on my feet. The problem is the hole has been dug because forbearance is not a long-term solution. Forbearance is the Band-Aid, okay? So I'll talk about for a second what the rest of it is. The first thing though is you've got to talk to your servicer about when they want you to make up the payments. We are learning more every day, and the rule book's being written every day right now. And what I mean by that is Fannie Mae and FHA, Fannie Mae, Freddie Mac, FHA, and VA, they don't know how to deal with all this either. And so they're kind of taking out their books of forbearance and their rule books and dusting them off and saying, well, that rule works fine. Ooh, that rule doesn't work so well in this environment. Let's rewrite that rule. And sometimes they're rewriting it good and sometimes they're not. As an example, and please take what I'm telling you with a grain of salt because I'm learning every day new information. So I'm telling you an example of what I understand to be true right now. But things are changing so quickly that what I understand to be true today is likely to be untrue tomorrow. FHA says if you have had a forbearance and you can't make your payments, then no problem, you're in forbearance. At the end of the forbearance period, whatever time, 3, 6, 9, 12 months, if you can't catch up the payments, then FHA will write a check to reimburse the servicer because we're making the payment every month on your behalf. And that's the pain for the mortgage bank. That's not your problem. It is a challenge for the mortgage industry because if we're losing money by having to write checks to cover the payments of people in forbearance, we have to make up for it by charging higher mortgage rates. We have to get more income over here to make up for our losses over here. So that goes back to what I said earlier about there's many reasons why interest rates are higher today than they should be, and the forbearance tsunami is one of those reasons. And so as we deal with this, we're basically, FHA said, as you get to the end of that process, we 3, 6, 9, 12 months, we'll reimburse the servicer for the money that they had put out, and we'll take all of the money that was owed by the homeowner, and we'll just create a new second mortgage, and we'll put it on the end of the loan. And so you only have to pay that back when you sell the house, when you refinance the home. You don't make payments on it. It's just a HUD loan. It's a second mortgage that's put onto your home. That is my understanding of how it works. Please don't take that as gospel. I need disclaimers everywhere right now. The rules are changing every day, but that's what I heard most recently. But the key is, no matter what, it is postponement, not forgiveness. And it's not likely to get postponed to the end of your loan, although I just told you that FHA is more likely to do it. Fannie Mae, Freddie Mac are not likely to do that. What they're more likely to do is a modification. A modification is 100% a negative impact to your credit score. You are literally saying to the bank, I cannot meet the obligations we agreed to. I need you to modify my terms, or I'm going to go into foreclosure. That's literally what you're saying when you do a modification, and it is a significant negative impact on your credit. Again, if it's the only way to keep your home and move forward, and you have a sizable amount of equity in your home, then by all means, do the modification, because that is way better than losing your home to foreclosure. The negative credit implications of modification are nowhere near as bad as the negative credit implications of foreclosure, but they are still significantly impacting your credit score, and it's going to bring your score down, and it's going to hamper your ability to purchase a home for the foreseeable future. But essentially, the modification does give the ability to restructure your loan long-term and be able to stay in your home. So here's the bottom line. If you have good credit and good income and a decent amount of equity in the property, maybe the simple answer is to do a cash out refinance, because that way you can pull out some reserves, keep it in the bank for a rainy day. It's a rainy day, and then you preserve your credit. And so that is a shameless plug for me. But the reality is, guys, it's a good choice when it comes down to, hey, I'm not comfortable right now with the things that are going on, and I'm worried. Maybe I'll go into forbearance as a defensive position to protect myself. Even though I can afford my payment, I want to protect myself. That's the wrong move. If there is nothing else you hear from me right now, if you have money in a rainy day fund and you are worried about your ability to pay your mortgage because your income has dropped, it's raining. That's when we use the money in a rainy day fund, is right now. Do not file for forbearance if you think that's just a way to protect yourself. If you've already filed for forbearance and this is changing your mind and you're thinking, maybe I don't want to do this, you have about a week to fix the problem. Because if you make your April 1st payment in April, then you're fine. Now you have to call the bank and tell them, hey, take off the forbearance. I don't want my loan to show it's in forbearance. But you have to make the payment before the end of April. If you wait until May, then you've missed a payment. You can't undo the negative impact of forbearance. It will impact your ability to borrow down the road, and there's no way to undo that. So that's my number one message right now I want to get across. If you've been thinking about forbearance, but you have the ability to pay the April 1st payment, then wait, see what happens, because it's not like you have to file a forbearance right now. Do it when you have to. Understand there are negative implications, but it's way better than being late on your mortgage. Do not be late on your mortgage, but if you can make your payment, make it. It is way better for you long-term than trying to do a forbearance when you don't need to do the forbearance. So I'll show you right now what the impact is on a potential borrower, and it shows up just like this. It says affected by a natural or declared disaster. So this was one of my clients. I've blacked out all the information to protect the innocent, but it popped up, and I asked the client, I said, hey, I see something on your credit report, and it's something I'd never seen before. Did you happen to file for a forbearance? And she said, well, no, why do you ask? And I said, well, it says here that your loan was affected by a natural or declared disaster, but I know that your house hasn't been impacted by an earthquake or a flood or a wildfire or anything like that, has it? And she's like, well, no. And I said, okay, did you ever talk to the bank about a forbearance? And she says, well, I called the bank, And I thought, hey, because of the fact of all this going on and our worry, I thought it might be better to keep some extra savings in the bank and not make our mortgage payment for 3 months, and then I can just pay it at the end of the loan. And so I called him and I asked him how it worked, but nobody answered. And so I thought, well, okay, forget it. I'm not going to do it if I don't know how it works. But then I happened to be on their website and I saw a button that said, click here to apply for forbearance. And she's like, well, yeah, I'd like to apply for it because I want to know what it means. And I said, okay, what happened? And she goes, I clicked the button. And I said, then what? And she said, nothing. I said, what do you mean? And she said, I haven't heard anything. She goes, actually, I lie. I had heard something because I called them. And I said, well, tell me what happened. And she goes, well, I called them and I told them I hadn't heard anything about my forbearance request. And they said, yeah, she actually got through to them. They said, yeah, we're super, super busy. And the government rules and the CARES Act didn't require us to communicate back to you. We're so busy receiving requests for forbearance that we don't have the time to tell you we got your request. We don't have the time to tell you what the terms are on the forbearance because our phones are ringing off the hook with people asking for forbearance. And we're just saying, sure, no problem, check, moving on to the next phone call. And so she said, what's going to happen? When do I pay it back? And they said, well, we're likely going to want you to pay it back after the 3 payments are skipped. So in July, you skip April, you skip May, you skip June, and then we're likely going to have you make the payment to us in July, or 4 payments in July. And she said, well, I can't do that. I mean, that doesn't help me at all. And they said, well, yeah, but that's the rules are right now is that, that's what's going to happen. And she said, okay, well then forget it. And she said, John, I made my monthly payment, and so I'm good. I said, yeah, you're not so much good because your credit report still says you were in forbearance. Because we know that affected by natural or declared disaster, the president declared a national disaster for the entire country over COVID-19. So if you raise your hand and say, hey, COVID-19 impacted me and I can't make my mortgage payment, please give me a forbearance, you've been affected by a natural or declared disaster. Not natural, but declared. And therefore, we know you're in forbearance, even though it didn't hurt your credit. We are aware of that. And with that knowledge, there's nothing in the law that says banks have to ignore the information they have. That's where it's going to impact you. And in her case, she was already enrolled in it and she didn't even know. So reminder, if you are in a forbearance and you don't want to be, make your payment. No matter if you can reach the bank or not, make the payment before April 30th, because then even if it's next month, we can get undone the forbearance implications on your credit so that there's nothing negative. But once you go into May and you didn't make that April 1st payment, we can't undo it because you took advantage of the forbearance. You didn't make the monthly payment. You're stuck. Again, yes, that does suck, Kathy, I agree. So that's your only option, is to make the payment now if you have the ability to. If you can't, this is not intended to be a guilt trip. It's not intended to make you feel bad. It's not intended to be any of those things except awareness, which is like with my client in this situation. She just wanted knowledge. She just wanted to know what it meant to be in forbearance. And once she knew, not for me, she says. So that's the thing. You need to understand it. So Wendy said, do you think the same thing will happen if they allow this for renters? There's been some talk of that. I don't know. I got to be honest, that scares the bejesus out of me. If we end up, basically, it's what happens to the landlord then? Because it's exactly what's happening to the mortgage industry right now, is that the government has said homeowners don't need to pay the mortgage company, but the government is not stepping in to help the mortgage company. We are responsible still for paying Wall Street for the mortgage. And so to make matters even worse, yesterday, Fannie Mae and Freddie Mac came out and said, hey, we'll help you guys. If there's a homeowner or a borrower who did a loan and they go into forbearance between the time you funded their loan and their first payment, the old rules were that Fannie Mae and Freddie Mac would not buy that from us, which means that the bank would lose a bunch of money. But now they said, okay, we understand your banks didn't choose this, so we will buy it from you, but we're only going to pay you 93% of what the face value of the mortgage was. What that really means is that if we loaned somebody $300,000 2 weeks ago, and 2 weeks later they lose their job and they go into forbearance, it means that we will only receive on that $300,000 loan, we will take a haircut of $21,000. In other words, Fannie Mae says, yeah, we'll buy the mortgage, but we're only going to pay you $279,000 back of the $300,000 that you loaned. And so we're taking a loss of $21,000 because the government said that you can file for a forbearance. And the government says, but if they file for forbearance between when you do the loan and their first payment, then we're going to take $21,000 or 7% of that mortgage balance away from the mortgage bank that started the loan. That's a real scary proposition to be in as a mortgage bank. Now think about it, Wendy. What if they do that for all renters? I understand the benefit to the renters, and I understand the need for that. But the unintended consequences scare the heck out of me, because what happens to all of the landlords? The landlords still have to pay the payment to the bank. That's going to force the landlords into forbearance. That's going to force the landlords into modification. It could force a landlord into foreclosure. I hate to say this, but what the government's doing to the mortgage industry is going to force some mortgage companies into bankruptcy, because they're not going to be able to afford to make the mortgage payments while the loan is in forbearance and lose 7% of the mortgage value if somebody files for forbearance within the first month. It is a significant, significant impact to the industry, and it is something that we all have to be aware of. So huge concerns. And guys, the tsunami is taking off. So what we see right now are numbers as of April 12th. And what we see were forbearances were super, super low back at the beginning of March because COVID-19 wasn't an issue. We weren't shutting down the economy. And so what's happened since then is significant uptick, and that was only as of April 12th. Most mortgage owners, most homeowners know that your mortgage isn't, you don't have a late fee until the 15th of the month, but if you're not going to make your payment, who cares if there's a late fee, because they won't charge it to you if you have a forbearance. So most homeowners are holding on. The call volumes to mortgage servicers this week have skyrocketed. The numbers aren't yet in here. We think it could be as many as 20 to 25% of people who have a mortgage in the country could be asking for a forbearance. The problem is that a large portion of those people don't understand that there's significant negative impact to the forbearance request, and they just assume the money's getting tacked on at the end of their mortgage, and they have a big surprise coming. Gang, this is about the end of my presentation. So I want to, first of all, thank you for coming. I have a few minutes left for questions. And so please feel free to post any questions. Here's seminars answered my questions, moving forward, purchase a small piece in Idaho. I'd love to help you. Thank you, Justin. I'll give you a call and we'll talk about it. Anybody else have any questions about anything else, please post it now. Again, I'll be here for a couple of minutes on Zoom. Post any questions you have on Facebook if you're watching me on Facebook right now. Please share this with anybody that you know. So it's on my Facebook personal page. You can find it on my YouTube page as well, youtube.com/JohnLoneKing. And I'm here to help. So Terry, you got a question? Feel free to shoot. Or at least you started with a hey, John, so I'm assuming that you're typing. You're welcome, Jenny. Thank you. All right, well, I'll keep talking while Terry is typing. Guys, feel free if you have questions about anything like this, shoot me a text, catch me on Facebook. There's a lot of challenges right now. Yes, Kathy, I will pick up the phone if you send somebody to me. You can send them to my cell phone as well, and I'll take care of it for you. So 209-423-1482. That's my cell phone number. So love to take care of you, Kathy. I appreciate it. Text me is a good way to reach me as well. So Terry, Tim, and you guys need to talk. Yes, I will give you guys a call. Tomorrow's my 21st wedding anniversary. So I am taking the day off. I'd love to say that we're going to go somewhere nice, but we're not allowed to. So we're going to stay here, but we're going to put the kids in the backyard and lock the door and hope they don't kill each other or drown themselves in the pool. And we're going to have a nice day inside. Okay, maybe we're not going to do that, but we are going to, I'm going to be taking the day off. So I'm not going to be calling you tomorrow, Terry, but I'll touch base with you early next week. You've got my cell phone number as well. So feel free to, text me or reach out next week. Thank you, Barb. I appreciate that. I got to tell you guys, shopping in this time frame, I have a double whammy because my wife's birthday is on Sunday. So we have the anniversary and then we have the birthday 2 days later. Lock them inside and have dinner poolside. That's a great idea, Wendy. I agree. So anyway, it's hard to shop and get stuff because it's taking so long to ship things, because obviously anniversary and birthday gifts are non-essential. But after being married for 21 years, I know that it's extremely essential to the health of my marriage to make sure that I am taking care of my wife. And so anyway, thank you, gang. Thank you, Imelda. I'm just talking just in case somebody has any questions about anything. So I'm going to wrap this up in a second. I like all the great wishes, but again, I was hanging out just in case people had questions about anything. So I'm going to go ahead and sign out. Really appreciate everybody tuning in. Love the opportunity to help you all in the future, and have an absolutely amazing night. We'll talk to you soon. Bye.